Welcome to the Deep Dive. We're here to cut through the noise, break down complex information, and give you the key insights you need without the overload. Today, we are plunging deep into a financial giant, JPMorgan Chase & Co.
Yeah.
We've got our hands on their latest 10K filing, that huge annual report. It's packed with details about their business, their risks, how they're performing financially.
It really is. It's much more than just a document they have to file. It's like a blueprint for how this massive multi-trillion-dollar institution operates in the global economy. So our mission today is to pull out the most interesting bits, the surprising facts maybe, and the strategy behind it all to give you a really clear picture of what makes this powerhouse tick.
Okay, let's try and unpack this thing, because when we say financial behemoth, we absolutely mean it. Think about this. As of mid-2024, JPMorgan Chase had a market value over, $573 billion?
That's right. And by the end of 2024, their total assets were north of $4 trillion. It's almost hard to fathom.
Exactly. And they reported net income for the full year 2024 of over $58 billion. That's a big jump from previous years.
Yeah.
So you're looking at a company that really does influence everything, from your local bank branch right up to global markets.
And to really get a handle on a firm this huge, you've got to start with its structure, how it's put together. As of Q2 2024, they actually did a bit of a reorganization, changed their reportable business segments.
Okay, interesting. So what was the thinking there? How does this reorganization actually change how they, operate day to day?
Well, it seems to be about streamlining things, getting more clarity. They now manage everything through three main segments. First up is Consumer and Community Banking, CCB. This is probably the part most people interact with.
Right, like consumer banking, small business stuff, wealth management, mortgages.
Exactly. Home lending, both originating loans and servicing them, and of course their huge card services and auto division. It's all about their direct touch points with millions of customers. And the 10K gives some interesting numbers here. For 2024, active mobile customers were up 7%, which is pretty healthy. Debit and credit card sales volume also climbed 8%.
But it wasn't all up, was it?
No, that's the interesting part. Average deposits were actually down 6%. And the card services net charge-off rate, that's basically bad debt they couldn't collect, was 3.34%.
So growing digital use, but maybe some pressure on deposits and credit quality.
It shows that tension, yeah, between digital growth and maybe some shifts in how consumers are managing their money. Then the next big piece is the Commercial and Investment Bank, the CIB.
Okay, this sounds like the heavy hitter division.
It really is. They combined what used to be two separate units here, so it covers investment banking, payments, lending, and all their markets and security services stuff, fixed income, equities, you name it. And performance-wise, in 2024, CIB's net income jumped 23%. Investment banking revenue up 36%.
Wow, that's significant.
It is. And what really stands out, Dealogic ranked them #1 for global investment working fees.
So #1 globally. That tells you something.
It signals a real strategic focus, I think. JPM seems to be leaning hard into that higher margin advisory and deal-making world, maybe seeing that as key for future profit in, a pretty tricky financial landscape.
Makes sense. And the third segment?
That's Asset and Wealth Management, or AWM. This is where they handle investments and manage wealth for big institutions, corporations, and also high net worth individuals through their global private bank.
Big money management.
Very big.
Yep.
AWM had client assets of $5.9 trillion in 2024. So it really highlights their role as, guardians of huge amounts of capital.
Right. So these three segments, CCB, CIB, AWM, they're distinct, but you can see how they fit together, this whole financial ecosystem. But who's actually steering this massive ship? You mentioned leadership changes.
Yes, absolutely. Some key moves announced around January 2025. Daniel Pinto, who is president and COO, is set to retire at the end of 2026. He's moving to vice chairman.
And who's stepping into the COO role?
Jennifer Piepszak. And Doug Petno is taking her old job as co-CEO of the CIB.
Okay, so some internal shuffling at the top. Any new faces?
Yes. They also brought in Michelle G. Buck onto the board. She's the chairman, president, and CEO of the Hershey Company. That was effective March 2025.
Hershey's CEO on the JPM board. Interesting perspective.
Definitely. These aren't just musical chairs, right? They feel like strategic moves, positioning the firm, ensuring they have the right leadership mix for whatever comes next.
So that's the executive team. But what about overall governance? How do they make sure everything stays on track with so many moving parts?
Well, the board of directors has ultimate oversight, obviously, looking at financial, strategy, all of it. What's interesting, though, is the emphasis on independent oversight. They highlight key committees, the Board Risk Committee, Audit Committee, Compensation Committee, all made up entirely of independent directors.
So people without direct management roles weighing in.
Exactly. And then there's the Operating Committee. This includes the top executives, like Chairman and CEO James Dimon. He was 68 at the end of 2024, by the way. Together, they act as the chief operating decision maker. They're the ones setting the day-to-day strategic direction. So it's distributed, but seems very coordinated. A model designed to handle that sheer complexity.
Okay, so a powerful structure at the top. But even the best-run ship faces storms, right? How does a company this enormous deal with the world of global regulations? It must be a maze.
Oh, it's absolutely a maze, an intricate one. Given how big they are and where they operate, they're under this dense web of regulatory oversight, both here in the U.S. and internationally.
So who are the main watchdogs?
Yeah.
And what does having so many regulators actually mean for JPM?
Okay, in the U.S., you've got the OCC, the Office of the Comptroller of the Currency, and the FDIC looking after their national bank subsidiary. Then the SEC and FINRA oversee their broker-dealer arms, and the CFTC watches their futures and swaps activities.
Just in the U.S., that's already a lot.
And that's just the start. Globally, you add the UK's PRA and FCA, the European Central Bank, ECB, German authorities. The list goes on. What it means, practically, is they have to invest massively in compliance. Huge teams, complex systems, just to try and meet all these different, sometimes even conflicting rules.
Wow. Okay, so bringing it down to a more personal level, are there recent rules that might actually impact, you or me as a consumer dealing with a bank like Chase?
Yes, definitely. The Consumer Financial Protection Bureau, the CFPB, is key here. They enforce fair lending laws, try to stop unfair practices. For example, in March 2024, the CFPB finalized a rule to slash late fees for big credit card issuers. Now, that rule is currently on hold because of a court challenge, but the intent is clear.
Lowering those annoying late fees.
Exactly. And there was another proposal back in October 2023 from the Federal Reserve to potentially lower the interchange fee. That's the fee merchants pay when you use a debit card, which the bank receives.
Ah, okay. So these rules are trying to directly shape the costs in terms of the banking services we all use.
That's the idea. And it's not just consumer stuff. New regulations are popping up that reflect, well, the modern world, like the EU's Digital Operational Resilience Act, DRR, that kicks in January 2025. It sets really strict rules for how financial firms manage tech risks, IT security, testing.
So focusing on cybersecurity and tech stability.
Precisely. And then there's the EU Artificial Intelligence Act that started phasing in February 2025, setting requirements for AI systems. It all points to this huge focus now on technology, on cybersecurity, and the ethical use of data and AI within banking. It's a massive shift.
It really is. When I think about bank risks, I usually think interest rates going up or maybe borrowers defaulting. But reading through this, the 10K talks about cyber attacks, biases in AI models, even climate change impacting them. It really broadens the definition of risk for a bank like this.
It absolutely does. The 10K lists out these principal risk factors, and yes, they cover the ones you'd expect. Regulatory risks, political risk like uncertainty from global events, market risks, credit risks, liquidity risks, all the classics.
Right, the usual suspects.
But what's really striking are the details in the other categories. Take operational risks. It's way more than just, did the computer system crash? They explicitly call out challenges in protecting personal data, the growing threat from sophisticated cyber attacks, and, interestingly, the limits of their own models.
Their forecasting models.
Yes, including the ones using machine learning and AI. The report flat out says these advanced models might not work as expected, maybe because they rely on historical data that doesn't predict the future anymore, or inherent flaws in forecasting, or even biases baked into the data itself.
Wow. So even their cutting-edge tech has known vulnerabilities.
It's a very candid admission, a reminder that new tech brings new risks.
And the climate change mentioned, that feels less like a typical bank risk. How does that play in?
Yeah, it's fascinating they detail it. They break it down into physical risks and transition risks.
Okay, what's the difference?
Physical risks are the direct impacts. Think more frequent floods, wildfires damaging property they've loaned against or disrupting business operations, or chronic things like rising sea levels gradually making coastal real estate less valuable.
Stuff you can physically see or experience.
Right. And transition risks are the financial fallout from the shift away from carbon. Changes in policy, new green technologies taking over, shifts in what consumers want. All that can impact the value of existing assets or investments.
So they've loaned money to, say, a fossil fuel company.
Exactly. Or invested heavily in industries that might become obsolete. It's not just about being green, it's hard-nosed financial risk assessment. It could mean lower asset values, higher insurance costs, business interruptions. And one more risk category they emphasize is conduct risk. It's technically part of operational risk.
Conduct risk, like employee behavior.
Precisely. The risk that someone inside the firm does something wrong, harms clients, messes
Hmm.
with market integrity, damages the bank's reputation. And even with tons of policies and training, the 10K acknowledges, past problems and the ongoing challenge of stopping bad behavior. It's that human element, right? Still a persistent risk, even in such a regulated environment.
It's a huge spectrum of risk they're constantly juggling. Okay, let's shift gears a bit and talk numbers. The 10K is obviously full of financial data, but they use terms like non-GAAP measures. What are those, and why use them if there's already an official standard like GAAP?
That's a really good question. So, GAAP Generally Accepted Accounting Principles is the official rule book in the US. But many big companies, JPM included, also present these non-GAAP financial measures. Think of terms like pre-provision profit or return on tangible common equity, RTCE, maybe net interest income excluding markets.
Okay, so what's the point?
The idea is to give investors and management a slightly different view, to help understand the underlying operational performance, maybe strip out certain one-off items or accounting quirks to see the core trends more clearly.
Like showing the engine's performance without the noise of the exhaust.
Kind of, yeah. Like a managed basis reporting, they use adjusts for some tax things to make comparing across different years easier. It's not replacing GAAP, it's offering an additional lens, another way to assess how the core business is actually doing.
Got it. An extra layer of analysis. And speaking of core health, capital strength is absolutely vital for a bank, isn't it? How do they measure that resilience?
Hugely vital. They talk about maintaining a fortress balance sheet, and the key metrics here are their regulatory capital ratios, mostly under the Basel III framework.
Basel III, that's the international banking standards.
Exactly. Think of a bank's capital as its financial cushion, its shock absorber. Regulators set minimum levels for how big that cushion needs to be relative to the risks the bank is taking. For JPM, their main ratio, the standardized CET1 capital ratio, was 15.7% at the end of 2024.
Is that good?
That's very strong, well above the minimum requirements. It shows a really healthy buffer against potential losses. Plus, they go through annual stress tests run by the Federal Reserve here in the U.S. The results of those tests determine their specific stress capital buffer requirement.
And if they don't meet these capital levels?
There can be serious consequences. Limits on paying dividends, buying back shares, even restrictions on paying executive bonuses. So maintaining that capital fortress is critical. And just to add another number, their liquidity position is also pretty staggering. End of 2024, they had about $1.4 trillion in available cash and easily sellable securities.
1.4 trillion readily available. That's a lot of ready cash.
Ab-
Shows serious resilience.
Absolutely. It means they can handle significant outflows or market disruptions.
Okay, let's talk credit risk. The risk that people or companies just don't pay back their loans. How does a bank this massive manage that? How do they guess who might default?
Yeah, credit risk is banking 101, but at this scale, it's incredibly complex. They break down their loan book into consumer loans, but separating out credit card loans specifically, and wholesale loans to businesses. Then they use this system called allowances for credit losses.
Allowances,
Yeah.
like setting money aside.
Exactly. Think of it like building up a reserve fund. Yes. Now, interestingly, that deal actually resulted in a huge gain for JPM, a $2.878 billion bargain purchase gain. Basically, they bought it for less than its assessed value, creating instant paper profit.
A bargain, literally.
But at the same time, they immediately had to set up allowances for potential losses on all those loans they just acquired from First Republic. So while there was a gain, they also had to account for the added credit risk right away.
That First Republic deal sounds like a major event. What about other, maybe more surprising financial events or income streams that aren't just basic lending or trading? Anything jump out?
Oh yeah, there are definitely some interesting nuggets in there. One really notable one in 2024 was this massive $7.9 billion net gain they recorded related to Visa shares.
$7.9 billion
Right.
from Visa shares. How does a bank end up with that?
It's a bit of a legacy thing. It stems from Visa's IPO years ago. Banks that were members got shares. JPM had these specific B1 shares. In Q2 2024, there was an exchange offer. They swapped them for other types of Visa shares, B2 and C. And then by the end of September 2024, they'd sold off all the C shares they received. They even contributed $1 billion worth to the JPMorgan Chase Foundation.
Wow, so a multi-billion-dollar gain just from managing some old shares from the Visa IPO.
Exactly. It's a powerful reminder that these huge banks often have these, non-core assets or historical holdings that can suddenly generate massive financial impacts, totally separate from their day-to-day banking operations. Another really fascinating, maybe less obvious area is how they manage mortgage servicing rights, or MSRs.
Okay, MSRs, what are those exactly?
So imagine JPM collects mortgage payments for loans owned by other investors. They get paid a fee for doing that servicing. The right to collect those future fees is an asset, an MSR.
Okay, sounds straightforward enough.
But here's the catch. MSRs are incredibly sensitive to interest rates. If rates fall sharply, what do homeowners do?
Refinance.
Exactly. They refinance, pay off the old loan early, and that future stream of servicing fees disappears. So the value of the MSR plummets when rates go down.
Ah, okay, so it's a risky asset to hold if rates are volatile.
Very risky. And the 10K actually details how they manage this risk. They use complex financial instruments derivatives, specialized securities, essentially as hedges. Financial insurance policies designed to offset those potential losses on MSRs if interest rates move against them.
So sophisticated financial engineering just to manage the risk on collecting mortgage payments.
It shows the level of complexity involved in managing even these seemingly niche parts of the balance sheet.
And finally, you can't talk about a global giant like JPM without touching on legal issues. It seems like a constant factor for them. What kind of high-profile litigation do they mention? What does it tell us?
Yeah, the legal section is always significant. It really underscores the constant scrutiny they're under. The filing details several ongoing material legal proceedings. For instance, there's the 1MDB litigation still going on in Malaysia, allegations of dishonest assistance related to big payments way back in 2009, 2010. JPM actually won a recent challenge on jurisdiction there, but it's being appealed.
The Malaysian Sovereign Wealth Fund scandal, right? Still lingering.
Still lingering. Then there's the aftermath of the LIBOR and other benchmark rate scandals. They're still facing global investigations and class action lawsuits related to alleged antitrust violations, particularly around U.S. dollar LIBOR manipulation.
Old scandals still costing money.
Potentially, yes. And there's ongoing shareholder litigation, too, tied to historical issues like alleged misconduct in precious metals and U.S. Treasury market trading, and also around their fiduciary duties in certain roles. It just highlights the immense legal and reputational risk they navigate constantly. And one related point that's quite notable, they have a specific policy now for recovery of erroneously awarded incentive-based compensation.
A clawback policy.
Essentially, yes. It means top executives might have to repay bonuses if it turns out the firm's financial statements were wrong and needed to be restated.
So if the numbers were wrong, the bonuses based on those numbers have to be returned.
That's the idea. It's a direct response to regulatory pressure for more accountability at the top. Another layer of control in this incredibly complex machine.
So, wrapping this all up, what does this deep dive into the JPMorgan Chase 10K really tell us? It paints a picture of just a truly colossal, incredibly complex company, doesn't
It
it?
really does. Colossal is the right word.
A company that's not just reacting to markets, but constantly adapting to this shifting landscape of regulation, new technology, global risks, even, as you said, the weather.
Indeed. And digging into documents like this, it gives you, the listener, this unique viewpoint. You get to see the inner workings, the intricate machinery of global finance. It's really a testament to the sheer scale of modern banking, where, tiny shifts in interest rates or a change in leadership or even employee conduct, it can all have these multi-billion-dollar ripple effects.
So when you step back from all the details, what's the one thing that really stands out to you from this 10K? For me, maybe it's that tension, the constant balancing act between their massive scale and managing these tiny, granular risks every single day.
That's a great point, the scale versus the detail. And maybe that leads to the final thought for you to consider. In this era we're in, with ever-increasing complexity, constant change, how will this relentless push for more transparency, for these incredibly detailed financial reports and risk disclosures, continue to shape not just the accountability, but the actual core strategies of the world's biggest financial players?